Thank you very much for the invitation. It's an intriguing time to be talking to you, but I think we're probably coming up to one of the most volatile times in financial history of the planet you could possibly ask for, with the level of overvaluation of stock markets, the economic results in America looking very poor. People are saying, what's going on? It's a difficult time to be doing the sort of job you people are doing, so let's talk a bit about why. And if you look at the standard education people get in finance, it's all about the efficient markets hypothesis, the idea that there's a separation between macroeconomics and finance. What happens in the economy is a separate story to what happens in finance. Finance really tells you the best way to provide the money you need for an investment. The investment itself, the results depend upon the real factors in the economy that you have no control over, and all the directionality goes from the economics to the finance, that type of level. I've always been a critic of these conventional views, and when I teach these courses I spend most of my time first of all outlining them and then trashing them at the end. I'm not going to do a great deal of that today. I'm just going to go straight into showing you some of the reasons why this approach just doesn't function. And talking mainly about macroeconomics as well, because a huge element of the real world which is left out of conventional economic theory is the role of private debt. And that's what I've been hammering, if you've been reading any of the work that I do in my Forbes blog and so on, the incredible importance of including the dynamics of private debt and how you understand the economy. And this conventional approach in macroeconomics, and again, this is what you learn in finance, you're told that it doesn't matter if you have a highly debt-based firm, because the people who buy into it can buy in without borrowing any money, and if you have a very lowly leveraged firm, they can buy with leverage. So the question of leverage has very little impact upon the valuation of a firm. That's the standard belief. Well, a similar argument about the relevance of debt applies in macroeconomics, and this is quoting from Bernanke now, disparaging the view that Irving Fisher put forward about debt deflation being the cause of the Great Depression. This is from his book called Essays in the Great Depression. And of course, Bernanke got the job as chairman of the Federal Reserve largely on the argument that he was the expert on what caused the Great Depression. And my view of him, he's not the expert on what caused the Great Depression. He's the expert on developing explanations of the Great Depression that are consistent with neoclassical theory. Now, the only one that's consistent, if I can take a pun out of drama, is the butler did it. Okay? It's not a suicide. The butler did it. The butler in this case, of course, being the Federal Reserve. So here he, first of all, rather than examining something which says it's an endogenous process, which is what Fisher was arguing, that it was caused by too much private debt and then by falling prices at the same time, he says this was less influential in academic circles because of the counter-argument. And read this one carefully, please. The debt deflation represents no more than a redistribution from one group, debtors, to another group, creditors. Now, I hope you can see there's a slight logical flaw even in that statement, because normally when people go bankrupt, they don't pay their debts. Okay? How can it be a transfer if they've gone bankrupt? But that mental attitude is there, first of all, that debt deflation is a transfer from debtors to creditors. Well, only if the creditors pay their debts in full, which of course they don't during a crisis like that. But then he says, absent implausibly large differences in spending propensities between savers and borrowers, pure redistributions should have no macroeconomic impact. And that's seeing debt as a pure redistribution of money from one person to another. So it's got no impact apart from redistributing who has money in the society. It's not creating money, for example. Now, then you get the great moderation coming along, and I'm sure that's a phrase which you would have heard quite a bit of talk about and up to about 8 years ago, the wonders of the Great Moderation. And again, this is Bernanke saying how much we've learned since 1979. This is a particular conference he's speaking at, and saying the past 2 decades, so 1990s, 2000s, have seen significant improvements in economic growth and productivity, but a marked reduction in volatility, dubbed the Great Moderation. And he largely took credit for the Great Moderation, saying it was better control of inflation by better monetary policy that meant there was no problem. So what they were seeing was this process. If you look at the unemployment rate in America, which is the red line, and the inflation rate, which is the blue line, then you see a trend in trending down. The peaks in each of the crises, the peak of unemployment back in the early 80s, the peak during the 1990s, the peak in 2000s, heading down. So smaller peaks, less and less volatility, and then all of a sudden, bang, this happens. Unemployment explodes, and for a short while, you experience deflation. Prices are falling by 2% per annum in 2009, 2010, before the full scale of the financial rescue that he largely engineered along with the fiscal policies under Obama occurred. So there's a huge problem here. They had no idea that crisis is going to happen. Well, my argument as to why they did is they left out an important factor in picking, which is private debt. So I'm whacking private debt in that same graph now, putting it on the right-hand scale. So they're ignoring that black line there on the basis that the level of debt, the ratio of debt to GDP, this is private debt to GDP, that ratio simply reflects a redistribution and therefore should have no significant macroeconomic impact, so we can ignore it completely. And that's, as I said, it's standard in finance, it's standard in economics to argue that effectively it's like a decision between consenting adults, not the sort of thing the state should regulate. Well, I'm now going to take a look at those unemployment and inflation data again. And this is now plotting the same data over time. So the dark is the beginning of the time series. This is smooth data, as you can see. And that's the time process of this smooth data. And it all is moving in the direction you'd want it to do between I think it's the 1980 data, 1980 to 2007. So you move from way out here with lots of inflation, unemployment, the stagflation experience, down towards here, and of course, I think this is right here is 6% unemployment. So about here with 5% unemployment and about here with 2% inflation is what Bernanke thought was where the system was headed, and then suddenly it does this. Absolutely inexplicable. Well, this is actually a three-dimensional graph, and I'm just showing you it from the top, the very top. Let's tilt it. It's now showing the ratio of private debt to GDP as well as inflation and unemployment. Now, that could just be a random pattern, of course, but as mentioned, I do a lot of modelling, mathematical modelling of nonlinear systems approach to economics. And this is a model of Minsky, Hyman Minsky's financial instability hypothesis that I built back in 1992. I've since added inflation to it. That's all I've really added from the paper I wrote back in the 1990s. So that's my data as well, unemployment and inflation. You can see the same basic pattern. Way out here, then it spirals in, looks like it's going to reach a nice little spot here, and then bang, this happens. What's going on? Now, I can guarantee there's a dynamic process lying behind this. What I'm saying by analogy is it's fairly similar to this one. There's only 3 equations in this and about 10 parameters. Quite a simple model. But it generates the qualitative behaviour we see over here. So I'm saying debt does matter. And by leaving out the level of private debt, they ignored the fact that this stability here was actually being driven by cycles in the level of debt, affecting the distribution of income, and have led to the crisis we've just been through. So what they're missing, by arguing that debt doesn't matter, they're seeing debt as a pure redistribution. They're not seeing debt creating money. And this is something which the Bank of England has finally had almost all they can take of the conventional economists. And I don't know how many of you have seen it. I think I refer to it here. I can certainly bring it up on screen for those who are curious. But in the beginning of last year, the bank published a wonderful set of papers called Money Creation in the Modern Economy. And it might as well be a hand-addressed letter to Ben Bernanke and Paul Krugman and all the mob that say that banks don't change the nature of macroeconomics, saying banks create money when they lend. So the funny thing is, though they've been told this, they continue believing that you can ignore the banking sector. So this is Krugman in the rather slanging match debate he had with me about 2 or 3 years ago, where he said that people like myself and also the Austrian school regard banks as being something that have unique powers for good and evil. He doesn't see it that way. Banks don't create demand out of thin air any more than anyone does by choosing to lend more. And banks are just one channel linking lenders to borrowers. So again, the intermediary perception of what banks do is one reason why they leave banking out of their thinking. And the essence of the opposition they've got to the case that I'm putting is called the loanable funds model of debt. And this is, again, Krugman elaborating on this very clearly in his book, essays called In This Depression Now. Just think of it this way. When debt is rising, it's not the economy as a whole borrowing more money. So rising debt does not mean rising amount of money. It's just a case of less patient people borrowing from more patient people. That's the vision they've got. Transfer from people who are patient people who save money, impatient people who want to spend it, and that's the whole explanation. And you can basically ignore it unless the impatient people spend much more quickly than the patient. It won't have much of an impact on the macroeconomy. That's the basic thinking. By the way, think about the extent to which there are pejorative terms in this so-called value-free discipline. Who are the nice people, the patient ones or the impatient ones? Okay? The terminology they use is loaded, perfect competition. Is that better than monopoly? Well, it's perfect, etc., etc. There's so much pejorative language in the way they write. Now, the intriguing thing is, if you model, as I've done in the next couple of slides, if you model their vision of reality, then their conclusion is correct. If lending is simply a transfer from savers to borrowers, if banks don't lend money, but simply intermediate between savers and borrowers, then you can ignore the level of private debt. So this is now putting together a software package that does that. Minsky was designed so I can do monetary modelling, because most economists, as you're probably aware from having done courses, do not include money at all in macroeconomics. Okay? Money is used to explain inflation, but it plays no active role beyond being an explanation for inflation. So Egerton and Krugman, as he's writing the paper which I was critiquing, had a patient consumer agent lending to an impatient investment agent in what's called dynamic stochastic general equilibrium model. And the investment agent paid interest to the consumer agent. The bank charges intermediation fees, so the whole bank's whole revenue is just out of arranging a loan. The bank doesn't actually do the lending in this model. So what I had was I took that basic concept and then put it into a dynamic model where both of them were industrial sectors, both of them therefore had to hire workers, buy output from each other, sell it to the workers, the banks and each other, and then I had the investing agent changing how fast it was borrowing and how fast it was repaying, and vary the levels of repayment, and nothing really happens. There's no real impact of the level of debt. So I put this together. It's showing it in double entry bookkeeping terms. I'm sure I'm talking to a room of people who can actually read double entry bookkeeping. Good. Not the usual situation I have. Economists have got to explain what it is. Okay. But the basic idea, every row sums to zero, including the initial conditions. So you can see reserves are 100 million, 100 billion, and you've got minus 20 being, I'm showing the amounts of the liability shown as negative and the equity, because I can do that using debit or credit. It's simply a switch, just whether you display debit or credit or plus or minus here. But of course, assets are shown as positives, liabilities and equities are shown as negatives, so all rows sum to zero. And what I've got happening here with the lending is the flow is from positive to negative. Okay. So that's just thinking in double entry bookkeeping terms. Of course, debt doesn't appear here because in this model, debt is not an asset of the banker or a liability. It's an asset of the consumer sector, it's a liability of the investment sector. So it turns up in those two tables. So my software package, which I'll show you in a moment, can generate multiple interlocking balance sheets. So if you wanted to use it to find quite a complicated structure for a corporate system, or instead of interlocking corporate holdings and so on, you could do it for that as well. And it keeps track any account you register, shown in any particular table. You make a change in one table, it's reflected in the other tables, and then you know what balancing item you have to do as well. So what's happening here, seeing that same transaction from the point of view, the lending transaction from the point of view of the consumer agent, there's lending taking money out of the asset of their bank account and creating an additional asset in terms of the debt that the investment agent owes to them, and of course they have to do without the money in the meantime, which is part of the whole argument. To lend in this model, you've got to do without money you'd otherwise spend yourselves. Now, when I simulate it, that's the Minsky model there. I'll bring it up on screen. This is the software, and each of these elements here is contains a double entry bookkeeping view of the system from the point of that agent. So that's seeing it from the point of view of the bank. That's exactly what I've shown you a moment ago in the PowerPoint slides. Now, what I've got over here is control of the rate at which lending occurs and control of the rate at which repayment occurs. And the numbers here are, I'm using an engineering concept called time constant. Those who've done engineering would be familiar with that idea. And 7 means it takes roughly 7 years to double the lending. Right, not 7, it's actually 63%, but it's a constant which is used commonly in engineering, a time constant. It's like turning upside down the rate of radioactive decay. You all know the idea about if you have a piece of uranium, it'll decay over 3.4 billion years. Okay? Well, you can set it up as what's called the time constant as well. How long to go from what you've got to 1/2 of that amount. So at the moment I've got 7 years, which means banks effectively double the lending every 7 years. I can make it smaller, double every 5, make it slower, double every 30, and equally for repayment. Currently I've got that every 9 years. So the lender would repay half the debt over 9 years. I can make that repay over 5, which is much faster, or repay over 30, which is much slower rate of repayment. But simulated, you'll see the growth rate here with a bigger screen. I can show you all the other graphs that you see on the PowerPoint slide. But I simulate that. Notice the growth settles down at pretty much 0. And now if I rapidly increase the lending, so when lending happens more rapidly, the economy actually slows down. If I slow down repayment, the economy slows down even further. So this is actually a dramatic increase in the amount of debt in the economy. I'll just show you that happening further down here if I grab the slide and drag it up a bit. Notice the debt levels rising quite radically. There's now more debt than money in the system, which is quite feasible. So I go back to the 0 again. And now if I simulate for a bit longer, and then I have a dramatic slowdown in lending, the economy actually accelerates with a slowdown in lending. And ditto with repayment, a much faster rate of repayment, another boost to the growth of the system. I'll go back to the original situation again. And let's just take a look. So you see the growth rate spiked a few times up and down, but it's pretty much been flatlining all the way. If I drag this up so you can see GDP, you can see that for the length of the simulation, which is 28 years here, at the moment, that's the time in years that the simulation has been running for, GDP has been flatlining at around 200, despite those substantial changes to the financial system. And the debt to GDP ratio has gone up and down again, but nothing much has happened to GDP. Okay? So if this was a structurally accurate model of lending, they'd be right to ignore private debt. Let's go back to the normal view again, carry on here a bit. So what about a radical thought though? What if banks actually lend money? Wouldn't that be an unusual place? Let's give it a try. So what I can do is come inside here and say that the whole idea that the debt is an asset of the consumer sector is a myth. It's the neoclassical way of modelling money, which the Bank of England told them, not the real world. Yes, there is some peer-to-peer lending, okay, but most lending is by banks to non-banks. So what I can do with the program is just delete the column showing the debt as an asset of the consumer sector and delete all the financial transactions that are shown here, because they're not between the consumer agent and the investment agent, they're between the borrowing entity, which is the investment agent, and the bank. Now, I've got to do a bit more fixing up. I need to fix my initial conditions a bit, but I know I can get away with leaving a couple of steps out of here to show you the basic idea. Now if I come back over here, because the debt is still a liability in the investment sector, Minsky remembers that. So if I say, what are the available liabilities that haven't been allocated as an asset? There's debt. And then Minsky instantly brings across the lending and repayment operations here. I've still got the bank fee there. I haven't got rid of that yet. That's a fiction. What I need to do now is show that the interest payment is actually made to the bank. So once I've done that, I've balanced all the flows in the model. I haven't changed what's driving the flows, and I haven't changed the initial amount, so it's not perfectly fixed up. But if I now re-simulate, go back to the beginning again and simulate, notice the growth rate is substantially greater than 0. So straight away there's something different happening. I'll pause at a moment and bring it down here and show you the level of money and the level of debt. And notice the money stock is rising. In the previous simulation it was constant, so the lending of money is lending is creating new money, exactly what Bernanke and Krugman insist doesn't happen, and the Bank of England does insist that it does happen. And then if I change the amounts now, so I have an increase in the rate of lending, notice the growth rate rises. reduction in how fast people repay their debts, it rises even further. Run that for a while, and let's now say there's some reason, and I can give you a good reason coming up in a moment, rapid increase in the rate at which people repay their debt, banks much worse willing to lend, the economy goes into a slump. And if I then go back to the original conditions again, which is what we're trying to do right now, then growth returns to its previous level. Now that's over a 13-year period. Remember the last simulation I took over 27 years. Look at what's happened to debt and money. You've had a boom and a slump there. With GDP growth, pardon me, I've probably moved a diagram around there as I tried to move that. Let's come up and get over here. That's why I like working with very high resolution screens. The boom and slump in GDP has been accompanied by a boom and slump in the debt to GDP ratio. So money matters, and all I've got to do is just change the institutional fiction from what the neoclassicals believe to the real world. So varying the amount of money has a dramatic impact upon economic activity. It can't be ignored. Now that leads me to the financial instability hypothesis, which is the area that I've been working on since 1987. Actually, it was a very good year to choose to read Minsky for the first time, just before the stock market crash in 87. So Minsky, his description of capitalism is rather different to what you get out of Modigliani, Miller and Famer and French and friends. He says, capitalism is inherently flawed, being prone to booms, crises and depressions. And this instability is due to characteristics the financial system must possess, not optional extras, must possess, if it's going to be consistent with full-blown capitalism, because that system will be capable of generating signals that induce a desire to invest and in financing that accelerating investment. A very, very different perspective to what you've been taught in mainstream economics. I think, to my way of thinking, this was the first vision of capitalism that I thought would make coherent sense of the whole thing, built on the foundations of Schumpeter and Fisher, and to some extent Keynes. So cycles, debt and non-equilibrium are essential parts of his thinking. Again, very, very different to the mainstream that most people get taught their economics and finance is. And notice this is him explaining the thesis. He said the natural starting point for analysing the relation between debt and income. Now that's something that's not supposed to have a relationship in mainstream thinking. That's his starting point. That's why it's my starting point as well. So take an economy with a cyclical past that is now doing well. So put your minds back to the 1990s. Okay, we've been through the slump of the 1990s. 92, 93, the economy is recovering. That was the dot-com bubble. The telecommunications and dot-com bubble comes along. And Minsky's point is at that time, when the recovery is underway, the inherited debt structure reflects the past history where the economy did not do well. So your debt levels reflect the previous boom, where you took on too much debt, and people are both encumbered with too much debt, given their current level of performance and expectations of the future, and also very wary about taking on more debt. It's therefore, when people put forward investment projects to banks and want them to get funded, they're conservative about the amount of gearing they'll take on. But because the economy has recovered, most of those projects succeed. And as Minsky says, notice his focus is not upon perfect competition, it's upon what happens in boardrooms. Okay? It's a real look at financial capitalism, the type of world we actually live in. He said, if people in that world, when you look at your results, you find that existing debts are easily validated and units that were heavily in debt prospered. It pays to lever. So the tolerance for debt starts to rise after that. People think the margins of safety were too great. And as a result, over a while, the acceptable level of debt in financing and arrangements rises. And again, this is again very much a Wall Street view of the world. In the deal making that goes on between banks, investment bankers and businessmen, the acceptable amount of debt to use in financing various types of activities and positions increases. So it's seeing a feedback between the state of the economy, people's expectations of the future, and the amount of leverage they're willing to take on, which then leads back into the economy itself. So you then get an increase of debt financing, which increases asset prices. Now notice again, rather than saying there's no relationship between the level of debt and asset prices, he's saying there's a direct relationship. The more debt you have, the more leverage, the more highly asset prices will be valued, which again is what we've seen empirically, and I'll show you some strong empirical data on that at the end of the presentation. So the economy is transformed by this process of increasing leverage into a boom economy. And a period of tranquil growth becomes a period of speculative excess. And again, one of Minsky's famous statements, stable growth is inconsistent with the way in which we finance investment. The way we finance it leads to expectations rising, which leads to more debt. It goes to positive feedback. And this is one of the great insights of Minsky. Again, there's one of these things, when you read this, you think, yes, that makes sense. And because many critics of capitalism, the Marxist style, talk about they call tendency for the rate of profit to fall and all this sort of stuff. They have a view of capitalism being a stagnating system. That's not capitalism. Capitalism is the system which gets caught up in euphoria. And that's what Minsky talks about, is that the fundamental instability is upward. The tendency to transform doing well into a speculative investment boom is the basic instability of the capitalist economy. And I think that, to me, that nailed it when I saw that verbal statement there many years ago. And it's a non-equilibrium statement. You can't understand this by thinking in terms of equilibrium, which again is one of those dominant concepts in neoclassical thinking. So just going through the steps in his process, he says, take an economy historical time, which is why I said 1992 is not a bad time to consider. You had a debt-induced recession in the recent past, which means both firms and banks are going to be conservative about the amount of leverage they'll consider. And this is not asymmetric information. Joe Stiglitz is one of the few neoclassicals I quite like. Okay? He sees everything through asymmetric information, and again tries to understand Minsky the same way. The borrower knows more than the lender does about their situation, therefore there's credit constraints, etc., etc. What Minsky's talking about has got nothing to do with asymmetry, nor with knowledge. It's about future expectations. And he said, in the economy, when you've had a slump, both firms and banks are going to be conservative about their expectations of the future. It's shared expectations. It's not asymmetric information. So you only get, given that fact that both sides of the borrowing equation have got dampened expectations about the future, the only projects that are going to be funded are going to be conservatively estimated. But because the economy is recovered, most of those projects succeed, which means both firms and banks revise the risk premiums after the event, increase the ratio of debt to equity they're willing to consider, and just put a higher valuation upon assets. And for a while you get positive self-fulfilling expectations coming out of that. With the decline in risk aversion, there's more investment. With more investment, the economy grows faster. So a positive loop in that nature. Asset prices also rise, making it profitable to speculate on rising assets. Okay? Any idiot can be a genius in a rising market. So, and you've also got this increased willingness to lend, and as I've shown you, that increases the money supply, which of course validates many of the investments people are taking on, increasing the money supply, increasing economic activity, helping you increase that valuation of assets as well. So you get riskier investments being taken on, and more of these are going to fail. Okay. Minsky talks about, the next phrase, talks about what he calls the euphoric economy. We said where expectations become so positive that everybody is operating in a state of euphoria. And the extent to which I've seen that word being used in the financial press long before any journalists read Minsky is quite something. I'd love to have somebody do a textual study of newspaper headlines, market reports and stuff over time, and see the fluctuation of the use of the word euphoria as an indicator of the state of mind of the market. Now, the real euphoric expectations let what Minsky calls Ponzi financiers. Now, hands up who knows, when I say Ponzi financier, who knows what I'm talking about? Most of you. 10 years ago, one or two hands would have gone up. Ponzi is a word that's come back into the vocabulary. Actually, he was a very intriguing man too, by the way. Charles Ponzi is not as much of a, pardon the French, arsehole as many of the people who do that stuff these days are. Quite a remarkable human being. Totally narcissistic, but generous at the same time. Weird combination. And there's a wonderful biography of him called Ponzi's, I think it's called Ponzi's Scheme. And I highly recommend a read of that book. It's just for the sheer humanity of the man, very, very different to what we have as a picture of him. But his name, for better or worse, has been identified with this sort of behaviour, where you have investments where the cash flow from the investment is less than your debt servicing cost. So technically you're bankrupt. Okay? How do you stay alive? You sell assets on a rising market, but of course you've got to hang on to the asset while you're still servicing the debt. And you've got to sell the asset before the debt servicing comes to knocking on the door. So you've got a desperate demand for money. You'll pay any rate to get money to cover you, because if you don't get it, you fold. Okay? So there's an insensitivity to interest rates from Ponzi financiers. They must borrow to service existing debt before they sell assets. And therefore they've got a very insensitive demand for money to the interest rate. They'll pay virtually any rate. And of course they drive up the rates everybody else faces in the market as well. So initially you've got a period where there's profitable asset speculation, reducing people's sensitivity to debt and the interest rate, increasing supply of money, market interest rates rising as well, and income distribution also changes when you go into a boom, because as the boom progresses, unemployment will fall, wages will rise, and that will change your calculations of profitability, and your cost of raw materials will also change. Rising cost of oil, rising cost of iron ore, etc., as the boom phase goes on. All that stuff means that you've got plenty of endogenous reasons why the system will break down. You don't have to identify some trigger like the Federal Reserve foolishly putting up rates, which it will do anyway. But you need to, this is an endogenous story I'm talking about now. So the changing cost structure can undermine your profit expectations. And that's what turns up in the model I'll show you in a moment. The Ponzi's are necessarily losing money. Okay? They're accumulating losses all the time. They've got to cover the losses by new borrowing. And of course their shares permeate society. Has anybody heard of the Ponzi called Christopher Skase? Yes, okay, Australian. You from Australia? Okay. One of my friends has papered her wall, her toilet with shares in Quintex. Okay, so it just got through the whole society. People buy this stuff and then suddenly the best thing you can do is wallpaper. And they can, of course, they can crash instantly. The reason I find Skase such a nice example is that he made a $3 billion takeover bid for MGM, which Sony ultimately took over. And Kerkorian was on the board and did the sort of thing you people do for a living brilliantly, and exposed that this guy was worthless and said, don't accept the offer. So the board turned down his takeover bid, and 1 week later he folded because he couldn't make a $12 million loan instalment payment. $3 billion, $12 million. If he'd got the MGM takeover, he would have paid the $12 million out of spare change, kept on going for another couple of years, and then trashed MGM. But in fact, he got stuck by Kerkorian earlier. So they've also got many of these euphoric investments are failing. That also mounts up, another endogenous factor. The rising rates can make conservative projects speculative in nature, and then people who are firms that are non-Ponzi can think they've got to do some asset sales to cover their financial position, and you find the market is nowhere near as broad as you thought, and that the entry of new sellers can flood the market, and down you go. And as soon as the asset price rise stops, then the Ponzi's are extremely exposed. They're the first ones to go bankrupt normally because they can no longer sell assets for a profit, and their debt servicing cost exceeds their cash flows, and they're more likely to get turned down when they go to the bank and ask for that rollover. So bang they go, asset prices collapse, your debt to equity ratio will rise in the meantime because equity will plunge while debt remains the same. The expansion of the money supply goes into reverse. Another one of my favourite anecdotes from back around the 80s period was a couple of conventional neoclassical style macroeconomists published an article in the Australian Financial Review predicting the inflation rate in 1988 would be 27%. The reason for that prediction was that the rate of growth of the economy was 3%, and the rate of growth of the money supply in 87 was 30%, therefore deduct one from the other, 27% rate of inflation. They were only wrong by 28%. It was -1 the next year. The money supply goes in reverse, investment evaporates, the economy slows down, you're back where you started again, a debt-induced recession. Now, that process, this time round for us, took us through the 2001-2002 crash of the dot-com, because behind the cascade in business borrowing was the rising level of borrowing by the household sector. So we actually mapped over that. We didn't actually have a crisis in 2002. It kept on going until 2007. And we hit the other end when you are now at an enormous level of debt. And I'll show you just how big that level of debt was in 2007. And now you say, well, what's the end game at this point? And Minsky's argument was, if you hit this end point of the cycle and you have a high rate of inflation, which is what we had back in the 70s and 80s, then that high inflation means a rising price level lets you pay off debt. Okay, the debts are constant in nominal terms. Inflation meaning your cash flow is rising, you can pay off the debts. Inflation basically gets you out of trouble. But of course the economy will be in a state of stagflation. So this is a Keynesian explanation for stagflation. And one of the main reasons that Milton Friedman trashed the preceding so-called Keynesian approach to economics was the argument there was no Keynesian explanation for the experience of high inflation and high unemployment. This is Minsky's explanation. Okay. Makes perfect sense, because the cycle will start again once those debt levels fall. When you have low inflation, then debts can't be repaid, and you fall into potentially a chain reaction of bankruptcies, leading to a Great Depression. This is back now explaining Fisher's point of view, but giving a process by which you can get to this point of too much debt and falling prices. With big government, the anti-cyclical spending of the government sector, unless it behaves like the European Union is forcing Greece to behave right now, that gives businesses cash flow they wouldn't otherwise have during the slump, which means they can repay their debts. Okay? Cash flow from households and businesses falls. Cash flow from government spending rises. It gives you money you wouldn't otherwise have to pay back your debts. I've got to get a glass of water, pardon me. Coughing a bit here. Straight for ruining your tape. Thanks very much. So let's look at that. And this is now using Minsky in another way to model the whole process. And I'll just show you where the charts that I showed you in the first slide where I tilted those elements in three dimensions came from. So this is a very simple causal model, and what distinguishes the approach I take to macroeconomic modelling, in common with a lot of people in what's called post-Keynesian economics, from what you would have been taught from neoclassical, is we have a structural way of devising models. We say, what's the structure of the economy? What flows does that give you? What stocks matter in that? And what is the overall dynamics? This is starting off here saying the level of capital, real level of capital, determines real output, given a capital output ratio, which real output determines employment, given a labour productivity, it determines the employment rate, gives you a wage level. When you subtract wages and interest payments from income, you have profit, giving you a profit rate. Down the bottom here off the scale, I then have investment being a function of the rate of profit. Investment is the rate of change of capital stock. You're back over here again. But what I've added into the basic model is if you have a level of investment that exceeds your retained earnings, then you borrow money to finance that. Now, I'm going to simulate this model. Let's just slow it down a bit because it does go rather quickly. I'll bring up these two cyclical windows as well. Minsky is the software package that's still under development. We don't yet generate three-dimensional graphs live in it. I'd love to get the capacity to do it. But what you get is a period of cycles in wages and the debt level. I've gone past the crisis point. Then I'll go back to the beginning again and do it more slowly. And if you look at let's see the inflation and with employment. You've got employment up. There's employment over there. Let's make that a bit larger. Messing it up a bit. But if you watch this chart and this chart, then what you see initially looks like a great moderation. Notice the cycles in employment are getting smaller, and the cycles in inflation are doing the same thing. So if you're only looking at inflation and unemployment, which is what the mainstream view gets you to look at, you think everything's wonderful. You're ignoring this one here. This is the ratio of debt to GDP. But your theory says it doesn't matter, so you ignore it. And then, without warning, that unemployment, which looks like this is actually unemployment stabilising here. I'm showing employment on the vertical axis. So when that starts to fall, that's when the economy is tanking. And inflation over here is going negative. And that, from your point of view, comes from out of the blue. Now, that's because you're looking at this wages employment cycle. You're not considering what's happening with debt. Put the two together, you see the type of pattern I'm showing you a moment ago. Now, that looks complicated, and one reason people often say to me, look, okay, you can build nonlinear models like that, but they're too complicated to understand. Well, in fact, they fall down to three really simple propositions. You can't work out what's going to happen by knowing the propositions, but it shows you the advantage of taking a structural approach to the model, because that model boils down to three simply irrefutable statements. The first one is that the employment rate, which is one of the three what's called system states in the model, the employment rate will rise if economic growth exceeds the sum of population growth and growth in labour productivity. That's a fact. Okay. Disputing that's like getting angry about gravity. Doesn't do your health much good. Okay. Ditto this one. Wages share of output will rise if money wage demands exceed the sum of inflation and growth in labour productivity. That is also a fact. And the third one, which is what this vision of economics adds from Minsky, the ratio of private debt to GDP will rise if the rate of growth of debt exceeds the sum of inflation plus the rate of economic growth. That's three quite straightforward, irrefutable statements. What makes it complex is the way they interact with each other. So you can disagree, as I say, disagreeing with those is like disagreeing with gravity, but the complexity comes out of how they interact, and you can't see that without simulating. You can't see it without putting it together. And that phenomenon of declining volatility followed by breakdown is not part of Minsky's verbal theory. That's something which I found when I first simulated this model back in 1992, and I finished off with a rhetorical flourish in the paper that came out of that 3 years later, saying that the chaotic dynamics explored in this paper should warn us against regarding a period of relative tranquility in a capitalist economy as anything other than a lull before the storm. Nice rhetorical flourish. I didn't expect it to happen, but fundamentally it did. So you've got to have a modelling approach which has things interacting with each other, whereas a huge part of the neoclassical way of thinking is separating things out. Finance does not affect macro. Okay. Macro does not affect finance, etc., etc. No, they do. When you include these interactions, and you get a much richer view of the world, but also a much more accurate one. So you get a very different view of monetarism coming out of this as well. I know that a lot of you would have been taught Milton Friedman's monetarism, and if you look back at that particular set of myths, Friedman first of all assumed an economy that always tends to full employment equilibrium. The original paper he had in that was a paper where everything was in perfect harmony, nobody was upset, until a helicopter flew over the country and dropped $1,000 bills out of a helicopter window. And I am not joking. That is how he wrote it in an academic paper. Okay? And the government, of course, he didn't ever set it, but the government was the source of the helicopter. And he had a constant velocity of money, so the rate at which money turned over did not change. And that meant, therefore, that inflation was entirely due to the government helicopter dropping too much money out the window. And you control the helicopters, you control the rate of inflation. The approach that I take, I'm beginning to describe as empirical monetarism, and that starts by saying the economy is non-equilibrium. It's a myth to treat it as though it's in equilibrium all the time. And private debt is by far the major source of money creation. The government can create it as well, but certainly without governments being obsessed by austerity, they're not doing anything like what they should be doing in creating money. So it's all come down in the private sector. The velocity of money, and this has been empirically confirmed by good, staunch neoclassicals doing empirical research, people like Kidland and Prescott, the velocity of money is highly volatile and very pro-cyclical, nothing like what Friedman assumed. But in fact, debt's far more volatile, and that's what drives the cycle. So when you actually include all this stuff, you go from what Friedman had, which was price level times real output is equal to the velocity of money times money, times the amount of money, and V was actually defined as that ratio. What I'm calling over here, sort of a modern monetarism, the price level times real output plus net turnover of asset markets is equal to the velocity of money plus change in debt. Okay, so new debt, and I'm deriving this, I'm putting a paper up on this later on this year in a review of Keynesian economics, deriving that result, that the actual amount of money in the economy at a point in time, its economic activity is the turnover of existing money plus the injection of new debt, which is what's creating new money. And that means the asset markets and the real economy have to be included together. You can't neatly separate the two, again, as mainstream theory gets you to do it. And then when you, let's say, what's the rate of change of GDP, then because you've got the rate of change of debt being an argument in actual measured GDP right now, when you look at the rate of change of GDP, you're going to get the acceleration of debt being a factor. So debt acceleration is part of what gives us the huge volatility we see in the actual economy. And this is now to put this all together. I could be talking through my hat if debt levels were small and not changing all that much. This is looking at both private and public debt in America over the last 180 years, which is pretty much the history of capitalism. The red line is private debt. The blue line is government debt. All the obsession by politicians is about government debt, largely because they're blindsided to the importance of private debt by the so-called economics education that they got when they did PPE. They're leaving us out of thinking completely. But if you look at the level of private debt that we reached in 2010, I had to normalise the data, by the way, working backwards. There was data here from the census, data back here also from the census, but recording bank loans rather than recording some bank loans rather than the debt of the borrowers. And so I normalised all the figures so the overlaps were made consistent. That's the pattern I got for the level of private debt. It implies that we had a higher level of private debt in this crisis than even the Great Depression, when deflation drove that ratio up. And people from my approach to economics, Wynne Godley being the first, began to warn of an inevitable crisis given this rate of growth of private debt back in 1998. I started warning in 2006. But we're still in the aftermath to it. The debt levels haven't even fallen back to the levels, comparative levels, to the worst of the Great Depression. And we're trying to continue on as though there's no problem. Now, that trend is common across the globe. I'm not going to show you 20 countries here, but I'll show you 4. USA, UK, Japan and China, private debt levels to GDP. Now, we all know that Japan went through the bubble economy and then has been in a slump since 1990. Notice where its debt got to back at that period. You've had this growth in the UK debt, which is now trending down. So you're in a period of deleveraging, though mainly with debt growing more slowly than GDP rather than actual outright deleveraging. America had a period of rising and then falling private debt. It actually went through deleveraging. Look at China. They avoided the crisis by making sure bank managers lent to anybody with a pulse. Now, normally I say that the government can't control bank lending. I make an exception for China because if you don't go into the Communist Party official tells you to lend, you lend. Okay? The alternative is not good for your health. Now let's look at the rate of change of private debt. And again, back to start off with Japan, notice that the rate of growth of debt, when you measure it in terms of percentage of GDP, peaked just after the crisis began. And this huge long plunge in the rate of change of private debt, and for most of the period of this century, the Japanese private sector, households and predominantly firms, have been reducing their level of debt. Now, a healthy capitalist economy does need credit growth as part of its demand on a regular basis. So part of why Japan's been in this slump is the private sector has been actually reducing its debt and therefore taking money out of the economy. It hasn't been credit creation, it's been credit destruction. It's been balanced by a huge increase in government spending. Come along to our crisis, there's America, the red line. Notice from the 92 period up to 2007 when the crisis began, and then it plunges. And for a while America's deleveraging. Britain looked like a drunken sailor, bouncing all over the place, but tending towards deleveraging. Look at China. Its economic growth since the crisis has been to an enormous level of leverage, exceeding at its peak the peak in Japan. Which is why I think there's just absolute guarantee China's going to have a crisis in the next couple of years. That can't be sustained. Now, I'm now showing you the relationship between economic growth and change in debt by looking at unemployment, which is predominantly determined by the rate of economic growth, graphing unemployment against the change in debt. And again, according to conventional theory, I again will quote Bernanke, there should be no significant macroeconomic effects. The correlation there over 45 years is minus 0.89. I reckon that's significantly different to zero. What do you think? So that's the Japanese data, and that data has been sitting there for us to examine effectively for 25 years, since their crisis began in 1990. This is the American data, starting in 1990. Anybody here ever do psychology and do a Rorschach test? They are so close to each other. That's a minus 0.93 correlation over 25 years. So to argue debt plays no role in macroeconomics is to deny the data. And there are investment implications to this as well, of course, because according to conventional theory, all the things I'm about to show you should be not correlated. And this one surprised even me, because this is the correlation of margin debt to the value of the S&P. Now, I don't argue that there's a causal correlation there. That's why I say it's unexpected. But there is a strong correlation between the level of margin debt as a percentage of GDP and the S&P. And notice we've reached a peak, pretty much the same as the last two. Well, I don't think that's going to be a source of growth anymore. So margin debt leveraging up asset prices, that's now out the window. That's why I'm saying at the moment you can expect an increase in volatility, because if this tends to come down, it will have an impact on the valuation of the market. The ones I do expect, the correlations between change in margin debt and change in the S&P. Again, conventional theory says that should be 0. It's actually 0.69. It's over 25 years. And then the real one that I focus upon, and I must admit a bit of cowardice here. I didn't actually do the statistics on this initially, because even though my theory argued there'd be a relationship between change in debt and the level of economic activity, and therefore acceleration in debt and change in economic activity, I simply didn't think the data would be good enough to find the correlation. So a bit of cowardice, I didn't test them. Then a guy called Michael Biggs, and some of you may know, Michael worked for Credit Suisse, I think, and Deutsche Bank at various times. He did the analysis with it, using a different theoretical approach to get there, and found the correlation. So I checked them out later. This is the one I was expecting. Correlation between acceleration of margin debt and change in the S&P. Now what you're seeing at the moment is margin debt is decelerating, which again is what implies to me you're going to be seeing a falling value on the S&P coming out of that. And the correlation there again over 25 years, 0.53. I'm not explaining everything, obviously, but a major component of it. And this is just single variables. I'm not putting together a model here. Okay? I'm not adding together what the theory tells me those components of change in debt and acceleration of debt should be. It's simple, straight correlations. That's how strong the relationships are that you're told in conventional finance theory are not correlation, not relationships at all. And finally, house prices. This is looking at using the data from Robert Schiller's excellent Irrational Exuberance for house prices going way back to 1890, but taking the last 25 years. And again, the correlation there is 0.77 between acceleration in mortgage debt and change in the value of the house price index. And again, the Americans rose for a while. It's petering out now. It's petering out because the level of mortgage debt is simply too high for it to rise much more. So the room for accelerating debt and for even maintain the velocity of debt is quite limited, because it's like trying to climb higher when you're already at Mount Everest. Okay? It's hard to go beyond that level. So we're going to have, because of excessive private debt, credit growth can't ever reach the rates we were used to in the last 20 years. It can't even reach the rates that are sensible in a well-functioning economy. And that's the real reason that growth rates have declined around the world. American economists are going on about secular stagnation. There's some elements to that which are correct. We have got a slowdown in population growth rates in most of the OECD. That will affect overall GDP growth rate. Energy will ultimately become an issue, but it's not one right now. And I think anybody says technical change isn't occurring. You know, they're using arguments about a slowdown in the rate of technical change. I'm sorry, the Elon Musks of the world are enough of a reason to say that's nonsense. We always think there's something special about our time. The special thing about capitalism has always been innovation. It still is. And there's plenty of potential for further innovation there. What's really happening is there's no room for sustained acceleration in debt. And therefore you won't get the investment finance coming forward. You won't get those projects being funded in the first place, even though they're there. And you're likely to get low and correlated asset returns out of it all the way, except when QE drives asset prices, which it clearly has been doing in America for the last 7 years. You would never have seen the rate of growth of the S&P from its bottom that we've seen without QE. And of course, living in super cities like London and having come from Sydney, you have elite incomes from all around the world driving your prices here, so you can get total bubbles in places like London, and credit growth and money growth in that region, but not affecting the rest of the world. And in terms of China, I think a crash is simply inevitable. It's only avoided a crash back in 2009 when its exports plunged, when the world went into the global financial crisis, because it caused a huge growth in lending that financed all those ghost cities, some of which I've been inside. It's actually had a faster rate of growth than Japan had during its bubble economy days, and it's now into the two danger zones that a colleague of mine, Richard Vague, who's one of America's leading bankers. Richard established two of America's leading credit card companies, and he became concerned about the level of private debt because, as somebody who is tracking very carefully, as you do when you actually own credit card companies, tracking the level of debt that his borrowers have, including mortgage debt, he became concerned that with the accelerating mortgage debt back in the 1998 to 2002, 2004 period, maybe his customers couldn't repay their credit cards. And he said, assured by all the economists he spoke to, oh no, don't worry, yes, their debt's rising, but so's their equity. And one of the chief economists he spoke to, and I think it was Barclays Bank, said, yes, okay, the debt's rising, but their assets rising too, and that's a trade I'd take any day. Shortly after which, Richard sold the bank, sold it to Barclays and got out nice and well financially. Now a philanthropist, and he's published a book called The Next Economic Disaster, Where It's Coming From. And what he did was an empirical study of financial crises over the last 1.5 centuries, and said every last crisis has had private debt exceeding 1.5 times GDP. Well, China's currently about between 1.8 and 2. And secondly, that debt level grew 18% or more over 5 years. Well, China's debt level grew 70% in the last 5 years. So I simply can't see it avoiding a crisis. And if you want to check out Richard's very empirically oriented analysis, that's where it is. And I'm finishing off on a Chinese story because I think we have our ultimate Chinese curse definitely applies to your profession now. May you advise in interesting times. Thank you.